There are three mistakes that separate investors who build wealth from investors who get destroyed, and I've made all three of them. Cost me $10,000 to learn this the hard way. Luna, $10,000 gone in 72 hours because I ignored three massive red flags. Meme stocks, another few grand evaporated because Twitter said it's a sure thing. And here's the best part. Every single time, I thought this time would be different. It wasn't. Because here's what Wall Street doesn't want you to know. The stocks that feel like the safest bets are usually designed to transfer wealth from retail investors like us to insiders who already sold at the top. You're not stupid for losing money. You're just missing the pattern. The same three mistakes show up before every crash, whether it's the Nifty 50, the dot-com bubble, or that AI stock your cousin won't shut up about. In the next 7 minutes, I'm walking you through the exact mistakes that cost me 5 figures, using real stocks, real insider data, and the checklist I now use before buying anything. Let's make sure you're not the exit liquidity. Mistake number 1. I bought Luna because everyone said it couldn't fail. Picture this. May 2022. I'm scrolling Twitter at 11 p.m. My timeline is flooded with people bragging about 20% APY on stablecoins. 20%. Meanwhile, my savings account is paying me 0.01%. I'm thinking, I'm literally losing money to inflation while these people are printing money. So I did what any financially anxious millennial would do. I FOMO'd in with $10,000. Here's what I didn't do. Check how the protocol actually worked. I didn't ask where the 20% was coming from. I didn't question why Anchor Protocol needed to pay that much to attract capital. Reality check. If something promises returns that high, someone is taking the other side of that bet. And spoiler alert, it's usually you. Luna's algorithmic stablecoin UST was supposed to maintain its $1 peg through a mint and burn mechanism with Luna tokens. Sounds fancy, sounded safe. It wasn't. The whole thing was built on confidence. The second that confidence cracked, the death spiral started. UST lost its peg. Luna hyperinflated. And my $10,000 became $43 in 72 hours. $43. Here's the thing I learned. Fundamentals always matter. Always. It doesn't matter how many people on Twitter say it's safe. It doesn't matter if your friend made 50% last month. If you can't explain in one sentence how the company makes money, you shouldn't own it. And if you want to see how this exact same pattern is playing out right now with AI stocks trading at bubble valuations, I made a whole video breaking down the warning signs. It's called It's Happening Again, and Nobody's Talking About It. I'll link it in the description. But first, let me show you the second mistake I made. But here's what really kills me. I made this exact same mistake 6 months earlier. Different stock, same psychology, same blind optimism. Because in January 2021, I did the exact same thing with GameStop. And this time, I ignored an even more obvious warning sign. Mistake number 2, I ignored what insiders were doing while I was buying. January 2021, GameStop is going parabolic. I'm watching it on my phone during a work meeting. $40, then $80, then $150. I missed the first wave, but then it pulled back to $90 and I thought, this is my chance. I'm getting in on the dip. I bought $3,000 worth at $92. Felt like a genius. Diamond hands, right? Here's what I didn't know at the time. While I was clicking buy, insiders were clicking sell. Not just a little, massive amounts. GameStop's CFO Jim Bell sold 41,700 shares in February 2021 at an average price of $225. Board members were dumping shares. The second the price spiked, they cashed out. Think about that. The people who know the company best, the ones with access to the actual financials, the actual strategy, they were running for the exit. Meanwhile, I'm holding because Reddit told me to. Because some guy with a screen name like DiamondApe420 said, hold the line. The stock eventually crashed back down. I sold it $64, lost about $900 on that trade alone. But the real cost wasn't the money. It was the lesson I didn't learn fast enough. When insiders are selling, you should be paying attention. This isn't conspiracy theory stuff. This is public information. Free tools like OpenInsider.com let you track Form 4 filings in real time. If CEOs and board members are dumping shares while pumping the stock on Twitter, that's not a bullish signal. that's your sign to get out. And if you want to understand more about how the market is rigged against retail investors, I made a video about the 4 warning signs that appear before every market crash. I'll link that too. Okay, so after losing money twice, I finally learned my lesson about fundamentals and insiders, right? Wrong, because there's a third mistake that's even sneakier, and it actually cost me more psychological damage than both of these combined. Because this time, I was actually right about the stock. I just had no idea when to walk away. Mistake number 3, I had no exit strategy. This is the one that gets everyone, because buying is easy. Selling? That's where your brain turns into scrambled eggs. I bought Peloton at $120 in January 2021. The pandemic was still going. Everyone was working from home. Gyms were closed. Peloton was the future of fitness. They had celebrity instructors, a cult following, and a wait list for their bikes. The stock had already 10 times from pre-pandemic levels, but I thought this is just the beginning. By May 2021, I was up 35%. My $2,000 position was worth $2,700. I should have taken profits. I should have at least sold half, but I didn't, because I thought, what if it goes to $200? What if I miss out on the home fitness revolution? Here's what actually happened. Gyms reopened. People got tired of their Peloton bikes, the company slashed prices, and the stock absolutely collapsed. By May 2022, it hit $12. $12. I held the entire way down. Why? Because I didn't have a plan. No stop loss, no profit target, no, if it drops X%, I'm out rule. I was just hoping, and hope is not a strategy. By the time I finally sold in late 2022, I was down 75% from my purchase, turned a $700 unrealized gain into a $1,500 realized loss, all because I didn't know when to walk away. Therefore, here's the framework I use now, and it's saved me from making this mistake ever again. Before I buy anything, I write down 3 numbers. Number 1, my profit target. If it hits this, I sell at least half. Lock in gains, take money off the table. Number 2, my stop loss. If it drops to this level, I'm out. No emotions. No, it'll come back. No, I'll just wait a little longer. Just sell. Number 3, my conviction time frame. How long am I willing to hold if nothing happens? 6 months? A year? 2 years? After that, I reevaluate or exit. If I can't write those 3 numbers down before I buy, I don't buy the stock. Period. This framework has saved me thousands. And if you're someone who struggles with when to sell, this might just save you too. So let's connect all 3 dots. Mistake 1, buying hype without understanding fundamentals. If you can't explain how the company makes money in one sentence, don't buy it. Mistake 2, ignoring insider selling. If the people running the company are dumping shares, why are you buying? Check Form 4 filings on openinsider.com before every purchase. Mistake 3, no exit strategy. Write down your profit target, stop loss, and conviction time frame before you click buy. These 3 mistakes cost me over $12,000 in real money and probably years off my life from stress. But here's the thing, I'm not special. Every investor makes these mistakes. Warren Buffett made mistakes. Charlie Munger made mistakes. Even Peter Lynch got things wrong. The difference is they learned from them. They built systems to avoid repeating them. And now, you don't have to learn the expensive way. You just learned from my pain. Here's the real secret that nobody tells you. Investing isn't about being right all the time. It's about being less wrong. You're going to make mistakes. You're going to lose money. That's part of the game. But if you learn the pattern, if you can spot these 3 mistakes before you make them, you'll protect yourself from catastrophic losses. And that's the actual difference between investors who build wealth and investors who get destroyed. If this saved you from making even one of these mistakes, do me a favor and hit that subscribe button. I make videos like this every week, breaking down the patterns Wall Street doesn't want you to see. Drop a comment below. Which of these 3 mistakes have you made? Be honest, because I guarantee you're not alone. I'll see you in the comments. And hey, if you want to keep learning, I've got a video about why even index funds might be a trap right now. I'll put it on screen. Don't make my mistakes. Learn from them. See you in the next one.